Hello, beautiful people, and welcome to another brand new episode of the ITU Forex class. In this week's edition, we're going to be talking about how to spot and trade key reversals in Forex trading. Okay, so for those of you who are completely new to this, we're actually talking about reversals, which is signs in the market that's showing you that a trend is about to end, and so you want to trade in the opposite direction of the trend. That's basically what a reversal is. So let me show you an example. Okay, so like I keep saying in these classes, if you've been following us for a while, we've covered a ton of classes, a ton of lectures about market structure, trending markets, and all of those. Okay, so basically, when a market is trending, you know that the structure of an uptrending market, for example, is that price is going to consistently keep forming higher highs, okay, and higher lows. So using this as an example, you can see that price was moving down. Okay, it was just going down, for what seems like forever. So let's ignore this part of the chart for the moment right now, okay? So when you focus your attention on this part of the chart, you notice that when price made this low, it actually didn't make another low which is higher, which is lower than this low for the time being, okay? And then all of a sudden, whenever it tried to come down, whenever it tried to fall down, it found it difficult to break below this low. And so it formed a low which is higher than this low, okay? This low that we are seeing right here. Now, this is the reason why we're going to use this as a reference point, okay? So we're going to say this is our low on the chart for now. And so when price made this low and then it moved up, it found it difficult consistently to break below this low and make a brand new lower low. And so when it made another low, which is somewhere here, this low, in theory, is actually higher than this previous low. And so this is a higher low, this particular low here. And then eventually price reached this high and it couldn't break higher. But then when it formed this low, it went up and broke above this high. So technically speaking, this is actually a higher low. A higher high. Okay. Now, when we look at this, you can see that we went from forming lower lows and lower highs, lower lows and lower highs, to now price struggling to form lower lows, but it's starting to break above highs to form higher highs. Okay, but then eventually we have a low here, which is lower than this low. So technically, even at this point in time, the trend didn't switch from moving downtrend all the way to start just moving in the direction of an uptrend immediately. It actually took a little bit of time before price now formed this low. And then it made a high which broke above this high to form a higher high. And so from that moment onward, it now started forming lower lows, lower highs, lower lows, okay, lower highs, higher highs and higher lows, higher highs and higher lows. And then eventually it you can see what we had here. Okay, so this is the structure of an uptrending market actually. Okay, let me quickly clean this drawing up of the chart. So this is the structure of an uptrending market, and if all is being well, okay, if let me see if I can highlight this. Okay, so you can see this is actually the structure of an uptrending market. Okay, now what we're talking about is reversals. The reason why we're talking about reversals is because when the market is trending, price does not maintain that trend forever. What I mean is, when there's a trend in the market, that trend is not going to last forever. If the market is forming higher highs and higher lows, that higher high and higher low formation is not going to last forever. So let me explain this to you with an illustration, okay? So let's say that price is in an uptrend, just like I showed you with an example here. Okay, and let's just use a picture perfect example to help you understand it better. Let's say price is forming higher highs, higher lows, higher highs, higher lows, higher highs, and higher lows. The theory is that trends don't last forever. And so if they did, price would continue forming higher highs and higher lows indefinitely. But we all know that the markets don't trend forever in one direction. Obviously, no matter how strong the trend is, there's going to be a point in time where there's either going to be a retracement, either on the higher time frames or something, or maybe a consolidation, something, just something that is going to make the trend to actually pause or maybe reverse temporarily before continuing to move in the direction of that trend. And this is all that reversal trading is all about. When you hear reversal trading, the idea is that you are trying to trade in the direction which is opposite the trend, because you know that trends don't last forever. So using this illustration, for example, we can say that, okay, since the market is moving in the structure of an uptrending market, we know that it's not going to last forever. And so at a point in time, price is likely going to reach a point where it's not going to be able to break above, okay, and continue moving in the direction of that trend. And then eventually it's going to either stall or try to reverse that trend and start moving in the opposite direction. With reversal trading, the idea is you want to be able to identify when that is going to happen so that you're going to take a trade in the opposite direction of the trend. If you're trading in the direction of the trend, it's either you're going to wait for a pullback for you to buy, okay, which is trading in the direction of the trend, with a stop loss and a take profit, okay, maybe aiming for 1:2, so whatever risk to reward ratio your risk management technique tells you to go for. Or maybe you're going to wait for a breakout, and so when that breakout happens, you're going to place a trade with a stop loss and a take profit, and whatever the case might be. When you're trading in the direction of the trend, you want to be taking trades in the direction of the trend. When you're trading reversals, you want to take trades in the opposite direction of that trend. That's all this is. Now there are basically tons of ways for you to place trades when you're looking for reversal trading opportunities. Okay, but I'm going to show you the ones which I found to work, to work very well, given the constraints in the market, okay, of risk management and all of that. So let's quickly do that. So one way traders do this is they're just going to trade on the time frame which the trend is. Okay, that's the time frame itself. In this case, let's use this. This is the 1 hour time frame of the GBP JPY currency pair. Okay, so in this particular example, you can either trade in the direction of the trend if you're trend trading, and then all of a sudden, when price shows you signs of potential reversals or whatever the case might be, then you're just going to take that counter trend trade. Okay, that's the trade which is opposite to the direction of the trend which is currently on the chart. You're just going to take that trade on this particular time frame that you're trading. Most of the times, this works well for some traders. But what I found is that most of the times, if you're trading in a very strong trend, let's say that the direction of the trend on the 4 hour or the daily time frame is bullish, and then you see a little bit of reversal on the lower time frame, like the 1 hour time frame, that reversal is usually not going to move very far. And so when you take a trade in that direction, you're actually going against the trend of the higher time frames, which in most cases is not a wise thing to do. And so more often than not, that's just going to restrict your trades, because your take profits are going to be very little, and then price is going to go against you more often than not, which will result in you having to take more losing trades, okay, which is a disadvantage in and of itself. And then the second thing is that when you get those winning trades, you're actually not going to get those winning trades with high risk to reward ratios, which would be more than enough to cover for those losses. So let me explain what I mean. Assuming you are taking a lot of losing trades, let's say your win rate is only like 30%, but if your risk to reward ratio is very high, that would compensate for the losing trades that you're taking and make you make more profits. Let's look at it from this way. Let's say your win rate is 30%, okay, and then you took like let's say 100 trades, okay. So in this case, with a 30% win rate, let me quickly pick this, okay. Let's say with a 30% win rate, and you took 100 trades, this would mean that 30 trades were winning trades, okay, 30 wins and 70 losses. Now, if it so happens that the average, whenever you take a loss, that loss only cost you a loss of 1% of your trading account's capital. Okay. And whenever you had a profitable trade, it gave you a profit of like, let's say 4%, because you're trading with a 1:4 risk to reward ratio on average. This would simply mean that when you multiply 4 by 30, which is each winning trade gave that, you want to get your gross profit. This would mean that 30 times this is going to give you a gross profit of 120%. Okay, so you have a gross profit of 120% of your trading account capital. And then let me pick this and move it up a little bit. Um, Let's see. 120%. And then your loss is, let's say, 1% times this 70, okay? Because you had 70 losing trades, okay? So 1% times 70. So your gross loss is going to be 70% minus 70%, okay? Minus 70%. Now, in this case, your net profit is going to be 120 minus 70, which would leave you off with a net profit of 70%. Now, in this case, even though you only had a 30% win rate, for the simple reason that whenever you took a trade that ended up being a winning trade, you had like four times the profits that four times what you lost on average. You still ended up making a very good amount of profits. Okay, so because of this, even though your win rate is low, that would not affect you negatively all that much. But what if, and this was the thing I was trying to explain to you, but what if you had a low win rate? But then instead of having a high profit risk to reward ratio, you had just a modest risk to reward ratio of something like 1:2. In this case, it's going to be more difficult for you to be able to end up making profit at the end of the day, because since your profits are relatively small and your win rate is also relatively low, it's going to be difficult for you to make enough profits to make back your losses and then make extra profits in the process. So in this case, let's say this you're trading with a 1:2 risk to reward ratio. You lost, whenever you lost, you only lost 1%, and whenever you won, you only made a profit of 2%. So in this case, this would mean that when you multiply your winnings, which in this case is 30 out of 100 trades, you're going to end up with a gross profit of 60%. And when you multiply your losses, you're going to end up with a gross loss of minus 70%, because every time you had a loss, it caused you to incur a loss of minus 1% on your trading account capital. So in this case, your gross profit, when you subtract your gross loss from your gross profit, you're going to end up with a negative, that's a loss of minus 10% on your trading account. So it's imperative that when you're trading like this, you need to either have a low win rate coupled with a high risk to reward ratio, high reward to risk, meaning whenever you're risking for 1%, you're aiming to make maybe 3 times what you're risking, or 4 times, or even much more than that. And when you do that, that profit, that risk to reward ratio is going to compensate for your low win rate. Or on the flip side, you should trade with a low risk to reward ratio, but then you have a high win rate. Because when you have a high win rate, this would mean that you're winning more often than not. And so the small profits that you're making from your high risk to reward ratio is going to be more than enough to cover for your losses. Okay. Now, one way that traders do this using reversal trading strategies is they will not look for reversals that are on the lower time frames. Okay, they're going to look for reversals, they're going to spot reversals on the higher time frames, and then instead of placing those trades on the higher time frames, they will now refine those trades, their entries and their stop losses and all of those. They will now refine them using the lower time frames, and then they will use the higher time frames to aim for their profit targets. Explaining it like this is going to make it hard for you to understand, but that's why we're going to do the practical method right now, so that you see exactly what I'm talking about. Okay, so let me quickly take off all of this things that I have on my chart, and then let's look at an example. Okay, so as I told you, when you want to do this, so that you have, even if you have a very low win rate, you're going to have a high risk to reward ratio, for example, a high profit potential, you need to identify your reversal areas using the higher time frame. Okay, so in this case, this is the chart of the USD JPY, like I told you. And then one way to approach this is for you to look at the higher time frame. This is the weekly chart. Now, when we look at this weekly chart, it's easy for anyone who knows market structure to see that this particular currency pair has been in a strong uptrend for the past, let's say, 3 to 4 years. Now, the reason why we say it's been in an uptrend is because you can see that price has been consistently making higher highs and higher lows, higher highs and higher lows, okay, higher highs and higher lows, all of a sudden. But at the moment right now, price is kind of struggling to continue forming those higher highs and higher lows. That means price is struggling to continue moving in the direction of the bullish trend. And so you're seeing in the past, we had this area on the chart where price formed this higher high. But then when price revisited this area, attempting to break higher than it failed to do so. In fact, the momentum was so not strong that not only did price fail to break above this area, but it failed to even test it equally. It failed to even reach this area. And so this is showing you that, look, we're having difficulty breaking above this resistance level or even testing it because the momentum in the market is not as strong as it used to be. Okay. And the same thing could be said for the bearish momentum that we have on the charts here, because here you can see that this was a higher low at some point in time. But then instead of when price came to test it again to break below it and maybe reverse from moving in the direction of an uptrend to now forming lower lows and lower highs to moving in the direction of a downtrend, it failed to also do that because the momentum to the downside is not as strong also. And so now it's struggling to go high, it's struggling to go low, and so this market at the moment is it's stuck in between a horizontal support and resistance trading range. Now, why is this important? This is important because remember, when we're trading reversals, by definition, reversals are when there's a trend in the market, an established trend in the market, and then price starts going against that trend. And identifying when to trade against the trend is our reversal trading opportunities. And so this has occurred on the charts multiple times when we're looking at these higher time frames. For an example, let's use this. Okay. You see, this was a support area at some point in time on the weekly time frame, okay? And then this would have been a key reversal area because when price came here in the past, it struggled to break below this area to continue moving down. And so when you are trading reversals using the higher time frames, what a typical reversal trader is going to do is he's going to identify this area on the chart, and then when price revisits this area going into the future, he will want to watch how price reacts to this area and take a trade whenever he sees that reaction. So let me show you with an example here. You see, this was a strong support area on the chart because when price came here, it couldn't break lower. So now when we draw this blue line on the chart here, we're actually going to wait for when price revisit this area to see how it's going to react to the area. And so I'm going to draw this here, okay? Another signal which is going to show us how this played out on the lower time frames. Now, when we go to the 1 hour chart, I'm going to drag this all the way back, okay? So currently, you can see that we've identified this area on the chart. Okay, this was the area I marked the second time. Okay, let's go back to when we marked it first. Okay, when we had that first reversal on the chart. Okay, so you see, this is where we had that first reversal. Okay, so basically, trading view selling that. This is what we get for now because it's a pre-plan. But without wasting any more time, you can see this was the area where price got rejected at initially. Okay, now when we do this, when we go to this currently, what we had here, you can see that when price reached this area, let me zoom in a little bit so that it's going to be easier for you to see the candles. You can see that when price came here, it found it difficult to continue moving down. And the reason why I say this is because we were actually forming a downtrending market structure. So price was forming lower lows and lower highs, lower lows, lower highs, lower lows, and lower highs. We were moving in the direction of a downtrending market. But then all of a sudden, when price revisited this previous support area, it failed to continue doing that. And then we went from forming lower lows and lower highs to all of a sudden, price now reversing against the current trend. And now it started forming higher highs and higher lows. Higher highs and higher lows. Okay, so it went from the market structure of a downtrending market to now forming the market structure of an uptrending market. And then when this happened, this was our cue to know that, okay, it looks like even if it might be temporary, for now the trend is not moving to the downside, but it has reversed and is starting to move to the upside. And so for a typical reversal trader, what he's going to do is, after he's identified this reversal, he's either going to place his trade when the market structure shifts immediately. That means immediately price now formed this low and then it couldn't break below this low. Some reversal traders who are aggressive are usually going to take a long trade immediately this happens, with the stop loss being below the low, because the idea is that if price was for whatever reason able to break below this low, then this level is not going to be a reversal level anymore, because price is going to continue to move in the direction of the trend. But if price fails to break below this low to continue moving in the direction of the trend and then it reverses to the upside, this is a long trading opportunity. While other reversal traders who are conservative are not going to enter immediately, they would much rather wait for price to form this low and this high, and then when it pulls back and fails to form a low that is lower than that, is not they are now going to take a trade and then place a stop loss, a much more conservative stop loss below this area. Okay, so whichever type of trader you choose to use, because we've talked about having conservative and aggressive trade entry approaches in the past classes, but the gist of it is that when you're trading with the conservative approach, most times your stop losses are going to be a little bit wider. And so if you're trading with hard fixed risk to reward ratios, like if you're risking 100 pips, for example, you're aiming for 1 to 4, then you're going to have higher profit targets like 400 pips or whatever. This would mean that your stop losses are going to get it a lot less, since your stop losses are very wide. And so you're not going to make as much profit as someone who has a tighter stop loss and is going for a higher risk to reward ratio. But the disadvantage of that is that you're going to have a much lower win rate. Okay, but it all balances out at the end of the day. You just need to realize what type of trader you are, which type of approach is more you feel much more comfortable trading with. Okay, so for this particular example, we've identified the key level using our higher time frames. We've identified the reversal or the change in market structure using the lower time frame, and now we're going to enter the trade using the lower time frame. So in this case, after identifying this, we could have taken the trade here, placed the stop loss here, and then what I was telling you earlier on was that most times, to increase your profit targets, to increase your profit potential, what some reversal traders would do is that they would identify the setup using the lower time frame and they will aim to identify a profit target using the higher time frames. Okay, so in this case, you can see this was the weekly chart that we identified the area of reversal here using the weekly chart. And then when price revisited that area, and so we saw a market structure shift, a market structure change on the lower time frame. Instead of placing the trade using the lower time frame alone, okay, and then after placing that trade, using the lower time frame to just aim for a simple 1:2 or 1:3 risk to reward ratio profit target. Most times, what this type of reversal traders would do is that they would identify the setup, place the trade, and then they will use the higher time frame, okay, to identify their profit targets. So, for example, you can see that now if our stop loss was here, and then we're just aiming for middle ground, the middle portion of this range, because price is not trading in a range. Remember, it's not moving in the direction of the uptrending market that we had on the weekly time frame. We're just aiming for the middle of the range. This would have been an easy 1:10 risk to reward ratio profit trade, because when we look at the weekly time frame here, you can see that when we identify this setup, okay, using the weekly time frame, this area, this reversal area, and we're going for, let's say, somewhere the middle of the range, this would have been a very good trade, which would have lasted, let's say, 1, 2, 3, 4, 5, or let me just pick this ruler. We would have entered somewhere here and exited somewhere here. So this trade would have lasted for about 8 weeks and a couple of days. Okay, about 63 days, let's say. So, but if you were risking, let's say, 1% of your trading account's capital, and you're aiming to make like this particular trade 1:10, you would have easily made that. In fact, that's not the only case. Some traders would much rather go for the complete opposite of the what do you call it, the range. And so this would have been a 1:13 risk to reward ratio trade you were aiming for, but price never reached there. And so for that, some traders don't just place the trade and place the profit target and just sit back, because if you did that, then you would have seen that, okay, price would have come all the way to around 1:12 risk to reward ratio in profits for you on this trade. But then because you didn't lock any profits or you didn't do anything, price would have come all the way opposite to your trade to even go back to break even. So some traders, after placing a trade like this, they would use something like a moving average on the lower time frame, like let's say for example the 4 hour time frame. And so whenever price makes a higher high or higher low, they're going to trail their stop losses, so that even if price was to move against them, they're actually not going to get out of the trade empty-handed after price must have given them all of these profits. Okay, so some traders would use a market structure approach to trail their stop losses. So when they enter the trade here, and then whenever price forms a higher low, they will trail their stop to there. Okay, so this would have been a higher low, and then after it formed and price continue to move up, they will wait for another higher low to form, and then they'll move their stop loss here, and then they'll move their stop loss here, continue moving it, moving it, moving it, moving it, moving it, up until the moment when price came here and tried to make another a lower high, and then they'll just exit the trade somewhere here. Okay, so there are various approaches for you to do it. It's just that if you're trading reversals of the lower time frame, what I want you to understand is that the reversals are going to be much smaller, and so basically you're going to be going for maybe 1:2 or whatever the case might be. But like anything in trading, there are positives and there are also negatives, so you just need to look for the middle ground, the one that you're most comfortable with, and then go with that approach. Now, this pretty much brings us to the end of this week's edition of the ITU Forex class. And as usual, I'd like to use this opportunity to let you guys know that the techniques that we teach in this ITU Forex classes most of the times are techniques which you can use to improve your trading skills using manual trading techniques. But there are also techniques and tools that we have in the company that would help you to earn on your behalf. They will help you to trade on your behalf, identify low risk, high probability trading opportunities, practice proper risk management if you follow our recommendations, of course, and then they're going to help you to earn while you're learning. Okay, so if you're interested in doing that, if you're interested in taking advantage of these tools that we offer, then please write so in the comment section or the description section, and reach out to us on the socials, and we'll be more than glad to assist you set everything up and get you up and running in as little time as possible. Now, with that out of the way, thank you very much for making time out of your busy schedule to come to this class and attend it, and also being as interactive and supportive as you have. I really look forward to seeing you guys in next week's edition. And once again, thank you and God bless you. Have a wonderful rest of your week, and cheers.